welcome everybody. Thank you for your time. And my role in life, and I'm going to talk a little bit more about this as we get through the slides, is to give you the tools and processes to get and stay profitable, build wealth, and achieve what you want to achieve. And bookkeeping, nobody in this trade, we were having this conversation earlier, very few people in this trade started their businesses because I want to do bookkeeping.
Yeah.
It doesn't happen that way. So
Can
it's not
confirm.
what you got into business, but it's what will keep you in business. And this week we do the bookkeeping, and next week we do the financial piece. In order for you to do the financial piece, bookkeeping has to be accurate. And so that's what we're going to talk about today.
Awesome. I am excited about this. I own an HVAC company in Maine, and this was the one I've been waiting for weeks. So let's go ahead and get right into it.
All right. I am going to share my screen.
Everybody, if you have questions, you can put them in the chat, and we can ask Ruth at the end, but let's all mute while she gets through the presentation.
Yeah, I have this big red question mark at the end.
Perfect.
So you can ask questions and all that, and all the things that you want to do. And just put them in the chat, and we'll be able to actually go through there and answer all of your questions. I will stay as long as necessary to answer all of your questions. So don't think I'm going to just, all right, it's 8 o'clock. We're done. If you have questions,
thank you so much.
I will hang around. All right. So
awesome.
Tonight we're talking about the bookkeeping fundamentals, and next week we're going to talk about the financial fundamentals. But in order to do financial fundamentals, the bookkeeping has to be accurate, because garbage in gives you garbage out. And first of all, thank you for being with me. Thank you for being with us. Thank you to SkillCat for asking me to present this for you tonight. I mean, financials and numbers are near and dear to my heart and have been since 1981. So I want to make sure that you all get this. In the research that we've done, 75%, an estimated 75% of all small businesses have mistakes on their financial statements. So that means that only 25% of them are accurate. 75%. And I've seen it, and I've talked to a few CPAs who say, no, it's more like 90. Terrific. 10% of the financials are accurate. That's exactly what we need to be able to make good business decisions, right?
I feel as though I'm in that wider percentage, so I'm here to learn.
All right. So as a bookkeeper is what we're going to talk about tonight. The bookkeeper's responsibility is to produce accurate financial statements, period. That is your job. All right. And so we're going to go through a lot of things here so that you understand what bookkeeping, and probably what I consider the 12 major mistakes that bookkeepers make that I see and have seen for the past 40 or so years. So you're going to learn some very basic definitions, what I call my cheat sheet that I used for years, until, one day it just like this and it was internal. I used to have this little, when we get to it, I'll tell you about it. Why bank accounting is opposite from your business accounting, and that's where the confusion comes in a lot of times. And then I'm going to give you the 12 major mistakes that I see that you all make on financial statements, and how to avoid them or how to fix them if you do see them. So let's get started. A little bit about me. I have been in this industry since 1987, and I have spoken for almost every manufacturer, almost every distributor over the years. I have 6 books. They're all on Amazon, they're all on Kindle, and I read all of them, so they're all on Audible. The bottom 3, Courage to be Profitable, explains P&Ls and balance sheets in English rather than accounting babble, and we go all the way through to 101 Dumb Financial Mistakes, which came out last September. So it's not even a year old yet. Thank you to all of my clients who provided all of the mistakes. No names are mentioned. All right, let's take some basic definitions. All right, so I went to college to be a chemical engineer. And you're going to say, what is a chemical engineer doing what you're doing? Well, it turns out that you have processes that you learn that are really, really very close to what the accounting and bookkeeping and financial processes are. So I found out I was really, really good in numbers. So the college I went to, the university I went to, did not have a single business course. They just didn't. It wasn't back then. So I'm in my first accounting class in MBA school, and this old professor walks in the door, and there's, a bunch of 27-somethings in the room, just like me. And he walks in and he slams, just like that, his chair up on the desk, and we all go like this. And he goes, Debit means left side and credit means right side. It means nothing else, and don't you ever forget it. And for somebody who is telling you the story 50, well, not quite 50 years later, I've never, ever forgotten it. So debit just means left side and credit just means right side. That's it. Do not put any other connotation into debits and credits. It's just left side and right side. Right? If you remember the chair banging on the desk that woke us all up, but it got our attention, and hopefully I got yours. So that's the difference between debits and credits. All right. Number 2, cash versus accrual accounting. Now, for those of you who are on QuickBooks, all it is that little button over on the left, and make sure that you're on accrual accounting. This is one of the 12 mistakes. So I'll spend a little bit of time here and I'll spend a little bit more time there. If your CPA says that you want to pay your taxes on a cash basis, that's fine. You must operate the business on an accrual basis, because this is why. Cash basis accounting means that you have a sale when you get the money in the door. You have an expense when you write the check for the expense. So you almost never have a loss, because you're not going to write a check most of the time if you don't have money in the bank to cover the check. In accrual-based accounting, there are receivables, there are payables, and there's inventory, which we all have. And an accrual-based accounting, when you send out an invoice to a customer, whether you're COD or not, it's considered revenue. When you get a bill in the door from a supplier, it's an expense at that point and goes to payables and expenses. So you have true revenue matching the expenses of those jobs, and your gross margin can be consistent. All right. So those are the really, really important things. Is if you want to pay your taxes, I think the IRS rule is up to 13 million. I think they might have changed it since they've changed all the tax laws recently anyway, and they do every year. But paying your taxes on a cash basis is fine. That's between you and your accountant. If they insist that you are on a cash basis for operating your business, go find another accountant. Seriously, they do not know what they're doing with respect to operating a business. They're trying to make it easy for them to do your taxes. And quite frankly, all it is 2 journal entries to convert the receivables and the payables. It does not take a whole lot of time. Or if you're on QuickBooks, just go to cash. It's that easy. So don't ever let an accountant, CPA, tell you you have to run your business on an accrual basis. They are flat out wrong for the type of businesses that we have. All right. All right. So that's the difference between cash and accrual accounting. All right. Number 3, this is the thing that drives me absolutely insane. Your chart of accounts, which is all the buckets you put all the different activities of the business in, has to be numbered. All right. Now, the enterprise version of QuickBooks does allow numbering online right now. I don't think yet allows numbering. It will at some point. The desktop allows numbering. So depending upon where you are, but you've got to number your chart of accounts. And the only way to make sure that all of your assets are together and all of your liabilities are together and all of your equities are together and all of your revenues together and cost of sales and overhead is to make sure that we have the right numbers for those types of accounts. Okay. All right, here's my cheat sheet. Remember I told you that debit just means left side and credit means right side? So this is what this cheat sheet means. A debt if you have an asset, which are things that are like cash, accounts receivable, inventory, fixed assets like your furniture, your fixture, your vehicles, and stuff like that. An increase in an asset is a debit, and a decrease in an asset is a credit. All right. On the liability side, it's flipped. An increase is a credit, and a decrease is a debit. Net worth is the same as liability because the balance sheet's together. Increase is a credit, and a decrease is a debit. Same for sales. And then it flips. Okay. So what does this mean? So let's say you're not sure how to put a transaction in, and you have to do it as a journal entry, i.e. you're entering itself. It's not going through your payables module or your receivables module or whatever. So for example, you got a new truck, all right? So what happened? You bought a truck, right? So your assets increased by the value of that truck. So the debit, let's say you bought the truck for $70,000. So you increased fixed assets by $70,000 because it's an increase. So it's, debit. And then the credit is the liability for, let's say you took a loan out for $60,000. And then you have $10,000 in cash, which you paid. So you have a credit going with an asset because you have cash going out the door. So I use this cheat sheet when I have to figure out, okay, what are we doing? Where's, what's the debit? What's the credit? And then you have to look at it from a perspective of, okay, is it an asset? Is it a liability? Is it net worth? Is it sales or is it expenses? So that's the way I use the sheet to make sure you don't screw it up, or I don't screw it up. Not that you don't necessarily screw it up, but just making sure that an increase in an asset's always a debit and a decrease in an asset's always a credit. So if you're writing checks, that's crediting because cash is going out the door. So just, if you want this, at the end of the session, I will give you my email address. And if you want this, my little cheat sheet, I use this and I had this on my monitor for years until one day it just clicked. All right. So it may help
I
you.
just took a picture.
It may help you, just making sure that you get things in the right buckets on your P&L and on your balance sheet. All right. So do not listen to bank accounting. So when you go to the bank and make a deposit, what does the teller say to you? I'm going to credit your account for this deposit, right? And we're thinking, go back here. Credit is a decrease in asset to us. But to the bank, it's a liability. Because when we put that money in the bank, they have to make it available to us if we want to write checks on it. So the banker's assets are our liabilities. So it's flipped. So whenever the banker says, I'm going to credit your account, you think debit because your assets are increasing by the amount of the deposit. The bank's liabilities are also increasing by the amount of the deposit. All right. So their liabilities are assets. And when you take out a loan and you're going to pay it back by month, what do they say? We'll debit your account for the monthly payment. All right. So you're thinking, oh, that's good. No, from our perspective, no good or bad. From our perspective, that's a credit to us because they're taking money out and it's revenue to them, sales, because they're getting money in the door and that little piece of interest. So whenever the banker says to you, I'm going to debit your account, that means they're taking money out. Good for them in terms of that's revenue for them. And it's an expense, it's an asset decrease in an asset to us because our cash is going down. So whenever they think debit, we think credit. Whenever we think debit, they think credit. All right. So that's the difference between our business accounting and the bank's accounting. So this is where a lot of the confusion comes in initially with people who don't really understand bookkeeping and debits and credits, because they go to the bank and go, bank goes, all right, I'm going to, credit your account for this deposit. And they do the same thing in your books, which gives you negative cash on your balance sheet. And as we all know, if you have negative cash in the bank will close your accounts because you'll be bouncing checks and they don't like you to bounce checks. All right. So they are opposite. Their debits are our credits. Their credits are our debits. Okay. So just remember that piece of it also. Okay. All right, I want to go through the 12 major mistakes on financial statements and how to avoid them. how to fix them if they're there. All right. Number one, the date on your profit and loss statement doesn't match the date on your balance sheets. So at the end of every month, you as a bookkeeper are responsible for producing a P&L and a balance sheet. And what normally happens when the dates don't match is you print out one of the two statements on, let's say, May 31st, which is tomorrow, and you forget to change the date for the second statement because you may be doing it on June 3rd or June 4th or whatever else it is. The two dates must match, otherwise your balance sheet will not match your P&L. They absolutely have to match. So if they're not matching, you just, change the date to where it needs to be. So, the both dates for the P&L and the balance sheet say May 31st, April 30th, March 30th, whatever the date is. And they're done at the end of the month. So can you pull a P&L and a balance sheet in the middle of the month? Sure. Does it make sense? No. Because you don't have all of your expenses in, you don't have all of your revenue in, you haven't balanced the checkbooks and reconciled all of your bank statements and your credit card statements and all that sort of fun stuff. They're done at the end of the month so that you have an accurate P&L and balance sheet as of the last day of the month. Okay. So that number one's really easy. Takes 1 second if they're not right. And it takes less than a second to look. And you can go, oh, oh my gosh, I just, the dates are different. Just reprint it with the correct dates. Number two, cash basis accounting. And I covered this when I gave you the difference between cash and accrual accounting. We as contractors must run our businesses on an accrual basis. Okay. We're not a totally cash business. And a lot of you are residential COD and everything else like that, but you still have inventory and you still have payables. Right? We have to run it on an accrual basis. The only cash basis that's truly cash is drugs. You don't give me the cash, you don't get it. And I hate to say it, but it is.
Thank you, Ruth.
It's truly cash business. Then you can do it that way. But all the rest of us have payables and we have receivables occasionally and things along those lines. All right. So how do you fix this? It is one button on QuickBooks. Just make sure that little button on the left-hand side in the upper left says accrual base. Again, it takes 1 second to fix this. And if you see that your statements are printed out on a cash basis, the first thing you do is go, oops, move it to an accrual basis and reprint your statements. They will look different and they will be more accurate on an accrual basis than they are on a cash basis. Number three, balance sheet doesn't balance. This happens not very often. The only time I see this happening pretty much is every once in a while, you're going to get a notice from QuickBooks that says, your balance sheet is out of balance. Would you like to rebalance it? And the answer is yes, because every once in a while, I haven't figured out what QuickBooks does, but it loses its mind every once in a while and doesn't balance the balance sheet correctly. So usually by saying yes, I think you have to be in single user mode to do it. You rebalance the balance sheet and everything is fine. So you just make sure that the balance sheet balances. So these first three are like this. Takes 2 seconds to do. Number one, making sure your dates are right. Number two, making sure you're on an accrual basis. And if QuickBooks sends you that little thing that says your balance sheet's out of balance, rebalance it. And these three are done. They're easy. All right. And they're quick. Well, rebalancing the balance sheet, if I were you, it's going to take some time to do it as a general rule. Leave for lunch or something along those lines, or do it at the end of the day when nobody else is online so that you can make sure it gets done before the start of the next day. Number four, negative gross profit. Okay. What does that mean? That means you bought a part for $1 and you sold it for 80 cents. No. All right. This is where negative gross profit happens. All right. So somebody, I'm not saying it's not you because you don't do the ordering, but somebody bought materials for a job that's starting the next month, for example. So I'll give you the example. One of my clients was freaking out one day and she goes, we lost $80,000 this month. I promise you they didn't lose $80,000 because if they lost $80,000, they probably would not have been in business or they would have had severe cash flow problems. what had happened is they had a big job starting the next month, and they bought $80,000 worth of materials and put it in this month rather than the month that they were going to get the revenue for it. All right. So gross margins or gross profits is revenue minus expense, and they have to be in the same month. All right. The only time you can have negative gross profits is for warranty issues or callbacks, because you have no revenue and you have expense, and then you're going to have a negative gross profit. But in the day-to-day operating of the business, we're not going to buy a part for $1 and sell it for 80 cents. We're just not going to do that. All right. So that's generally what happens there. All right. So just make sure that if you see this big bill for materials from supplier X, that, is this for this job that's starting whenever? Make sure that at that point you put those materials in inventory, which is a balance sheet item, and not in cost of goods sold until you're actually ready to use them. That's how you solve that particular issue. Number 5, negative cash value. All right. You can't have negative cash in the bank. As we talked about, the banker would absolutely close your account, and you'd not have an operating account or a payroll account or whatever it was. All right. So generally what happens is, all the bills that have to be paid this month, and you print them all out and you leave them on your desk, and you pay them as the money comes in to pay those bills. At the end of the month, there's still checks sitting on your desk. QuickBooks doesn't care. Sage doesn't care. They assume that that liability, that payable, was no longer there and just pulled the money out of cash. Well, they don't realize that there's still checks sitting on your desk. That gives you the negative cash value as a general rule. So the rule is you never, and I don't use the word never very lightly, but you don't print out a check unless you're actually going to pay it. Not most of the time, but there's a lot of times now that we're not even doing checks anymore. It's ACHs, it's credit cards. I've seen too many checks get stolen. I've seen checks get washed so that they put different values and dollar amounts in it and made them payable to themselves. I mean, checks are becoming less and less used for those very reasons. So negative cash value shouldn't happen. And, are we human? Yes. Will we occasionally overdraw an account? Hopefully not very often, but occasionally does happen, and just make sure that we're there. All right. So generally negative cash values mean that that's what's going on. Okay. Number 6 is negative accounts receivable values. All right. I see this a lot for companies who are using specific software, right? When you're setting up your software, your CRM software, whatever else it is, software company has to have a current liability account called deposits and a current liability account called deferred income. Okay. So if you do not have a deposit account set up, this is what happens. A customer gives you a deposit on a job. The software goes, oh, we got cash, but we don't have any receivable against it. So that means that we have a negative receivable. That's exactly what happens a lot of times. And on the maintenance plan side, when you have deferred income, if Mrs. Jones pays you in advance, or she pays you monthly for work that still has not been done, if it goes into revenue, you're going to have revenue and no expense, and your gross profit's going to look wonderful. In the months that you have all the work that you do for, the maintenance and the inspections and all that sort of fun stuff, you're going to have all this expense and no revenue, and your gross profit's going to look like garbage. So that's why those two accounts have to be mapped in whatever software that you are using. So the two accounts, again, are in current liabilities under customer deposits, i.e. customer pays you before the job is done, or, for a deposit for a job that's going to be done later, and deferred income. All right. So those two things have to be in current liabilities and mapped into your software. All right. That's why we will not have negative accounts receivable. I mean, I've seen negative accounts receivable of, you know, 100 and some odd $1,000. No, you do not owe your customers 100 and some odd $1,000. What has happened is you've gotten deposits for that amount. Well, probably more because you have some real receivables, and that's what's happened. All right. So there are no negative accounts receivable. Now, when you print out your accounts receivable aging report, sure, Mrs. Jones, you might owe Mrs. Jones 52 cents or a negative $1 or something like that because she overpaid by a few cents or rounded up or something like that. Sure, I see that all the time. That's fine. But that's not what I'm talking about here. What I'm talking about here, when you see the negative $22,000 in accounts receivable on your balance sheet, when you see all those negative numbers, you can look and just look in current liabilities and know that there's no customer deposits in current liabilities. And that's why you have the negative accounts receivable. Okay. So to get rid of it, whatever CRM software or software you're using on the front end that ports over into QuickBooks or any, you know, Sage or anybody else, you have to tell them to map deposits to customer deposits as a current liability. And then when you bill it, you take it there. And so the bill becomes the amount less the deposit. So for example, if Mrs. Jones gave you $10,000 deposit on a $30,000 job, you got the cash in the door, which is your debit, and the credit is for customer deposit of $10,000. Job's $30,000, you finally bill the job. So you have revenue of $30,000, accounts receivable of $20,000 because the customer's already paid the 10. And your customer deposit then goes to zero. All right. So that's essentially how this happens and how it works.
Makes sense.
All right. Number 7, negative inventory value. All right. We can't have a negative bottle of water. Don't work. So somebody used inventory and put it in the wrong spot. And that's all I can say about it. I'd rather see no inventory on your balance sheet than negative inventory. I mean, think about it. We can't have negative inventory. It's a physical impossibility. It's stuff. It's like this pen. I mean, it's there, all right? So somebody has basically put something into the inventory account, excuse me, at some point in time, taken in more out than putting it in. So basically what they happened is, my little cheat sheet, increase in inventory is a debit and a decrease in inventory is a credit. So they're crediting inventory forever and there's no debits to offset it. So it becomes a negative number. All right. So here's my thing. If you're going to use inventory, and I hope you do use inventory, use it right. Right. And I'll talk about this more next week. But I have owners of companies who grow to $2-3 million who still don't have inventory on their balance sheets. For a lot of different reasons, mainly laziness, and they don't want to deal with it in reality. So I say to all of them, I said, how much inventory do you have? I don't know, $100,000 worth of inventory. What are you planning on doing? Are you selling the company? Are you passing it down? What are you doing? Oh, I'm planning on selling the company. Great. The multiples right now for sales are somewhere between 4 and 6. So you're going to tell me you're willing to take $400,000 to $600,000 less for your business because you have an extra $100,000 in expense. And there's dead silence, just like that was. All right. Putting inventory on.
It makes sense.
Putting inventory on your balance sheet is really, really, really important. All right. And that's not the subject of the session at all. All right. Number 8, negative accounts payable value. Now, how do we get negative accounts payable? Think about it for a second. Can we really have negative accounts payable, which means you've overpaid all of your bills in aggregate? All right. So what happens generally is you put things into accounts payable through your accounts payable module, and then you pay the bills through write checks. Don't work that way. If you're going to put it in as accounts payable, you got to pay it out of accounts payable. You cannot pay it out of write checks. All right, put it in, take it out. That will give you the negative accounts payable. All right. I see credit card statements that have, well, let me get to that in a minute. But you've got to make sure, I mean, look at your aged payables report. Where's the negative numbers? I mean, if there's a negative number to one of your suppliers for negative $22,000 and change, you know that that entry was put in the wrong way. You know it. Because I promise you, your supplier, you did not overpay your supplier by $22,000. Knowingly, let's put it that way. The other thing that I do see is occasionally you put it into accounts payable and you pay it by credit card, which screws up both of those accounts. All right. If
Yep.
you're gonna pay a bill, where'd you enter it? Right? If you put it in the payables module, it's got to get paid out of the payables module. The rule. Otherwise, your books are going to be screwed up. Right. Number 9, negative credit cards payable. I've seen negative $1 million in credit cards payable. I promise you, your credit card company does not owe you $1 million. This is the same thing that happens. You pay it one
no.
and you enter it in a different way. However you enter them. So, for example, if you have, QuickBooks is really good about this, because in QuickBooks, what you do is they have accounts payable and they have credit cards payable. So they separate the two, right? And sometimes that's really bad because you'll put the credit card invoice into accounts payable and pay it out of credit cards payable. You have to watch what's on QuickBooks to make sure that the other opposite transaction is what you want it to be. So if you're paying a credit card and you entered all the info, you know, all the expenses into the credit card, make sure that you've got the liability account being credit cards payable, not accounts payable. All right, that's how this gets screwed up. However you put it in is the way you got to pay it. All right, otherwise your books are wrong and you won't know what you really and truly owe. All right, so you can't have negative, well, you can. I mean, you might have returned something, but it's not a return for $1 million. All right. It might be returned for a couple hundred, maybe 1,000. But the reality is negative credit cards payables usually means you entered it one way, you paid it another. And you may not knowingly be doing it because you're not paying attention to what the liability is. You know, it's always cash out because you're paying the bill, but you're not paying attention to what the other side is. And because that's assumed unless you change it in QuickBooks or whatever accounting software that you're using. All right, just be careful in what you're doing. Number 10, negative loan payables values. Okay, this happens most of the time when you take a loan out to buy a truck, for example. Excuse me. And let's say the truck payment is $750, 250 of it is principal and $500 is interest. Okay. So what happens is you, instead of taking $500 in interest and putting that as a P&L expense under overhead interest expense, the entire loan repayment goes against principal reduction or the liability. So towards the end of the loan, you're looking at it because all the interest has not gone onto the P&L. You're looking at less that you owe than is reality. And at the end of it, it becomes negative. So I promise you the bank doesn't owe you money for that vehicle. That's generally what happens. So when you're doing, sometimes you're setting up automatic payments and things along those lines. You can have the payments go to two different places when you're writing those checks or setting up those automatic payments. Like a lot of it, like Ally Bank now is all online, and they just pull it out of your checking account, but they also will give you an amortization sheet that says, okay, this is the amount that's interest this month, this is the amount that's principal. And that's what you have to put into your accounting software to make sure that your loan amount is accurate and the interest expense goes on your P&L, which makes your bottom line look less, but it's also accurate at that point. At the end of the year, if all of the interest, that's it's $500 a month, that's $6,000 a year in interest, and that's there rather than on your P&L, you're going to pay taxes on $6,000 more than you should have. Now, I know the bookkeeping part of it, you're not paying the taxes, or you may be writing a check for it or whatever, but it's the owner's responsibility. And why would you let your owner pay $6,000, more than
Well,
he
that's the point of them hiring you.
All right, number 11, negative payroll tax payables value. All right. I know of one situation, where this was real. So one of my clients uses one of the public, and I'm not saying which one, payroll companies to, they do their payroll and everything else and pay their payroll taxes, da 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 da. Well, this lovely payroll company literally overpaid their state payroll taxes by $75,000. Talk about a pissed off owner. Oh my God.
Oh my goodness.
All right. It took forever to get it back. But in that case, negative payroll taxes payable value was real because the state literally did owe them $75,000. That's the only time in 40 plus years I've ever seen that happen. All right. Now I've seen, overpayments of a little bit or underpayments of a little bit, but not $75,000. Now you can tell this wasn't a little company either. All right. So generally, when you're doing payroll taxes, whoever's doing them, whether it's QuickBooks or whether it's, one of the private or public companies who's doing your payroll taxes, they give you a statement at the end of every payroll period that has the total amount taken out, how much was your responsibility with respect to your piece of payroll taxes, et cetera, et cetera, et cetera. And what happens when it gets negative is it's not accounted for properly based on what the payroll sheets say. So what generally happens is your liability is for the entire amount, and it's usually zero because they're not letting you have any liability. They're taking it out just as they're not letting you have it for a week. When you pay your payroll, you're paying your payroll taxes. And if you're smart, you also get them to pay your workers' comp like we do. I mean, there's always an audit, and it's always zero because we pay it based on what payroll is. So generally what happens is it's just messed up with respect to what's actually on the payroll report versus how much is actually an expense to you, which is the company's portion of the FICA and Medicare expense, and the employee has the FICA and Medicare expense. The employer also has the state and federal unemployment and that type of thing, but it is not an expense for the withholding that's withheld out of their checks. And that's generally where the mistakes come from there. So just make sure that you get it right. And it's not really hard once you figure that you don't owe the whole thing, you owe the payment for all of it. And assuming that you're not doing your payroll yourself internally, it's zero every payroll period because it's all paid. So why is it negative? Because somebody entered the information wrong. All right. And so you really have to look very carefully and make sure that, everything was paid, the amount of cash that came out is the amount that came in cash that came out for their payroll, i.e. their net, plus their payroll taxes, plus the amount of payroll taxes you pay for the privilege of doing payroll. And all those sort of fun things. But that's generally what happens here. And number 12, year-to-date net profit doesn't match year-to-date retained earnings. All right. So basically what this means is your P&L year-to-date number doesn't match your year-to-date retained earnings number on your balance sheet. Something is radically wrong here. Where I would go back and I'd look and I'd make sure, number one, that it balanced at the beginning of the year. And if it did, then you entered a number with the wrong general ledger number to make it not balance. The other thing that I would do is pull out your receivables, aging receivables report and make sure that the total matches the total on your balance sheet, and do the same thing with your aged payables report to make sure that your aged payables match the payables amount on your balance sheet. All right, that's where it might be also. But as a general rule, somebody entered a number using a retained earnings account when they shouldn't have, if they don't match. Okay, because in normal accounting, in normal bookkeeping, whatever is your net profit year to date, let's say it's $100,000, it has to match your retained earnings for the year, or net income for the year of 100,000 on your balance sheet. All right, the two numbers have to match. Otherwise, we don't have a balanced balance sheet, all right, versus what's going on with your P&L. All right, so those are your 12. First three are really, really easy, takes 2 seconds. Then we get into the ones that really and truly look at it to make sure that, number one, you're matching revenues against expenses in every single month. You're reconciling all of your bank statements and all of your credit card statements every month. And I find owners are really probably some of the worst offenders in not giving you receipts. Make them give them to you, because that's the only way you can balance and reconcile the accounts and the credit cards. Okay? If an employee didn't give a receipt, it would go on their, take it out of their paycheck. You can't do that for employees and not employers. And the employer goes, well, yeah, I own the business. Yes. But the reality is that personal versus business, the two have to be totally separate if you ever want to sell your company. You can't mix business and personal funds in a company. And a lot of times when I start working with companies, I see it. And I've had situations where they've paid housekeepers out of there, nannies out of there. And I said, no, you raise your salary to cover that and the taxes, and you pay it personally, which is where it should be. I am a real stickler. If you're going to run a business, you run a business, so that we can look at it and make sure that, if it's truly not profitable, we can figure out where and why. If we have inaccurate data, we can't figure out where and why. All right, so that's really and truly your responsibilities to make sure that the financial statements that you produce are accurate. Revenues matching expenses, no negative cash, no negative receivables, no negative payroll taxes, except in that one instance, no negative loan payments. Everything, both sides of the balance sheet should be positive, with the exception of accumulated depreciation on the asset side. And sometimes we have treasury stock or owners withdrawals or shareholders withdrawals in the equity side on the balance sheet. And that's the only negatives you should see. That's it. All right. Any questions? I will take questions. Do you want me to pull down chat? Let's see.
Don't be shy. Don't be shy.
Okay,
So everyone's good.
good. So if you want more, let's see, let me give you, I have a manual that goes through all of this in a lot of detail, and it's a literally you have a company and you do all the journal entries and you create a P&L and a balance sheet. And everything we went through today is in there in a whole lot more detail and examples. So if you go to hvacchannel.tv and click on products, you can find it there, or there's the QR code for it. For the manual if you want it. It's yours forever. We just had a situation where a bookkeeper left and they hired a new one, and we just, gave her the password again because she couldn't find it. And she's now doing the class. Don't have to pay anymore. It's just once. That's absolutely it. All right. If you want my cheat sheet, or if you have questions that we're not comfortable asking in front of everybody, that's my phone number. Those are my email addresses, and that's our website address for this type of thing.
Write it down. Write it down. Ruth, actually, you can feel free to put it in that chat as well.
Okay. Let's see.
But yeah, if you guys have any other, sort of questions or concerns about this, you can reach out to her
Send
contact.
me an email. Yeah.
Yep.
Yep.
Awesome.
So in all reality, you as a bookkeeper are absolutely responsible for creating accurate financial statements. That is your job. All right. If you need help bookkeeping wise, read a book, take a class, do a manual, whatever, but that's your job. It really and truly is, so that the owners can make really good business decisions on accurate information that you provide the owner. Okay? I will take any final questions that anybody has. Good, you all got perfect P&Ls and balance sheets, so you're not 75%, right? So if I asked all of you for your P&Ls and balance sheets, I wouldn't find any mistakes on them, right? No answer.
Here now, they're holding their papers up and they got mistakes on them, but they're too afraid to say.
No, that's fine.
No,
I see too many. So anyway, listen, thank you so much. Wait a minute, there's something that came in the chat.
Don't know
I don't know where to begin. All right. So send me an email and we'll talk. All right. That's probably the best way to do this. And let me see where you are, and I'm happy to help you knowing where to begin. Send me the email. I'll get back to you tomorrow because it's almost 8 o'clock here in the East. I don't know where you are. For those of you who don't know where to begin, send me emails. We'll talk by phone. I'm happy to do that. All right.
Awesome. Well, hey, Ruth, thank you so much again for hopping on and educating us on, the thing that we might not always want to do, but the thing that is very, very necessary to get right.
Yeah, none of us started the businesses to do this, but it's the thing that will keep you in business and not give you any surprises, which is not where you want to be. And then next week, same time, 7 p.m. Eastern, we're going to go through the P&L and balance sheet fundamentals and the things that you've got to look for there. So I assume that by next week, we'll all have accurate financial statements so that you can do the next piece of it and make really great decisions for your businesses. So thank you so much for your time this evening. And again, give me a call. I'm happy to help any of you. So have a great evening.
All right, guys. Yep. We'll see you guys next week. Have a good one, everybody.
All right. See ya. Bye.
Yep. All right. Bye, Ruth. Very nice meeting you.
Nice meeting you too.